If I were to offer you an investment that got a rate of return of 11%, and offered you another investment that got a rate of return of 5%, which would you choose? Most would say option A, of course. But the reality is that's only half the story. So today, I want to pack the other side of the coin, and that is investment risk. Hello, and welcome to another episode of the True Wealth Retirement Show. We have Matt Poor. I'm Planner Mike, certified financial planner professional and owner of True Wealth Financial. I believe that retirement should be prosperous, enjoyable, and purposeful. This is a show that's dedicated to helping Christians retire with confidence and clarity, so they'll be freer to serve God and live the life that they truly desire. Thank you so much for tuning in today. We've all heard it. Investing involves risks. But what does that really mean? How can I tell how risky something is or not? Well, that's what we're going to unpack today. Today, I want to unpack the different risks that we have when it comes to investing, do a deep dive into market risk, the value of an investment essentially going up and down, and show you how this really plays out in retirement. And we'll close with a micro action to help you get one step closer to hopefully confidently retiring. So when it comes to investing, there are a lot of different risks, and most people aren't even aware of all of them. So I want to kind of enumerate a couple of them, but I really want to kind of classify them in two different camps, two different buckets, if you will. Right? There's risks that you can control, and then there's other risks that you can't control. So here's what I mean. Some things that you can control. So the first one is diversification risk or concentration risk. Right? You have control over that. That's the idea that you can spread out investments across sectors or asset classes or geographies to help reduce that risk, right? Don't put all your eggs in one basket, right? Last week, we even talked about the idea that you can and ideally should diversify investment vehicles and diversify tax implications of those vehicles, right? So you certainly have control over that. The second one that you also have control over, similar but different, is asset allocation risk, right? You can allocate different amounts, different portions of your investments into stocks or bonds or cash equivalents or real estates based upon your goals, your objectives, and your risk tolerance, right? You have the ability to be able to do that. Another risk that comes into play with investing is that of liquidity risk. Liquidity risk is the idea. Liquidity is just a fancy term for how fast can I turn this asset, this thing that I own, into cash. Liquidity is the amount of time, right? So for example, money that's in a money market account, it's already in cash. It's already there. Liquidity is instantaneous. If you have an investment that you can trade, it takes generally 2 days to get that sold, cleared, put back into cash, and then maybe transfer it to your bank account. So it might take you 3 or 4 days. A house that you have to sell or a business you have to sell, that could take weeks, months, years even to turn into cash. So liquidity risk, liquidity is just a fancy term for how fast can we turn this asset into cash. And there's a risk associated with that. If you need cash right away and everything's tied up where you can't get it, it's in retirement accounts where you can't touch it because you're under 59.5 without penalty, that's a risk, right? So you have control over that. The easiest way to mitigate that is by having an emergency fund, 3 to 6 months of cash set aside. Another risk that you have is behavioral risk, right? So behavioral risk is the idea that how you behave when things kind of go planned or unplanned, right? So with some awareness and with some discipline and maybe the professional help of others, you can minimize or take advantage of the emotional decisions in times like panic selling or chasing fads that often hurt or help or hinder progress or performance, right? The automation and utilization of an advisor can help with these types of things, but you have complete control over the actions, decisions, and choices that you make based upon behavior. The last one that we'll point out here that you have control over is the idea of cost risk, right? So not when it comes to costs or fees or taxes or transaction costs, it's not a level playing field. Some are expensive, some are cheaper. So by choosing low cost funds, tax efficient accounts, smart trading habits like systematic rebalancing, avoiding things like wash sales, right? You have an impact of the cost that you pay and the transaction costs associated with your investments. You have a lot of control over that. Can you get rid of all of it? Probably not, because these services are provided to you through custodians and mutual fund companies or ETF companies or things like that, or discount trade firms, right? E-Trade, Scottrade, things like that, right? There are some costs associated with utilizing those services, but you have a lot of control over those costs. Now, shifting gears a little bit to, there's other risks that you don't have any control over. Now, obviously, like all things, what you invest in, you can avoid some of these things, but if you're in there, those risks materialize, you don't have a lot of control. So the first one is market risk, right? We call it systemic risk. This is the idea that stocks or assets or investments go up and down based upon economic downturns, or they go up based upon economic euphoria or booms or expansions, right? And we're going to do a deeper dive into those in a second. There's also investment rate risks, right? So when rates rise, bonds go down in value. There's an indirect correlation there, because if rates go up, nobody wants the bonds that you have because they can go get a new bond paying more. So your bond becomes less valuable in the marketplace. Conversely, the opposite is true. When rates go down, you have a bond that's paying like 5% and rates go down to 4%. Well, now nobody wants to buy, a 4% bond. Yours becomes more valuable because of the fact that there's more demand for your bond, right? So there's an indirect relationship in investment rate and bonds, an example. But you have no control over what the federal market does. You have no control over what the bond market does, right? The rates are the rates and they go up and down accordingly. Inflation risk. Inflation risk is the idea that the cash that you have in savings is losing value over time. Right, we've been through a high rate of inflation the last couple of years. You have seen the loss of purchasing power. $1 in 2025 buys a lot less than $1 did in 2000. Right, that you see that, you've experienced that, and that happens from time to time. It's always there, generally speaking. There's always a little bit of inflation. Sometimes in seasons there's a lot more, and you feel it, and you're a lot more aware of it. But again, it's not something you can really control. Another one is that of credit risks, right? So we talked about bonds. If you have bonds and you're buying a municipal bond or a corporate bond, there's a chance that that municipality, like Puerto Rico has in the past, or Illinois has, threatened to, for example, that they can't pay what they promised. You buy a corporate bond, that corporation has hard times, files bankruptcy, et cetera, whatever. They default on their bonds. They can't pay back what they borrowed. And then there's obviously geopolitical and regulatory risks, things like that. So wars, trade policy, tax law changes, regulatory shifts, all those types of things can have a direct or an indirect impact on your investments unexpectedly. So there's a whole bunch, and there's even more than these, but I just want to kind of give you the idea that, while most of the time we focus on rate of return performance, there's the other side of the coin, and that is risks. And there's a bunch of risks, a lot of which we don't really, have insight into, but they're there kind of behind the scenes. So when it comes to market risk, I want to unpack that a little bit more. You might have heard it say that no risk means no reward. And that is true, but not all risk is worth taking, right? So risk and reward when it comes to investing kind of go hand in hand. So years ago, I used to do a presentation talking about the keys to investing. The fourth of that was understanding risk versus reward. So I want to kind of draw this out just to kind of help you illustrate this a little bit. So assume we have an XY axis, with the x-axis being your return and the y-axis being risk, right? So there's a spectrum, right? The less risk you take, the less return you get, right? As you take more risk, you get more return, right? And so kind of keeps going up over time. And at some point, it kind of does level off. So for example, let's just say this is, savings accounts. The savings account is very low risk, very low reward, right? Like more than likely, the only way you won't get your money in a savings account is if your bank folds up and you have more than the FDIC amount, right? So very, very low risk, very, very secure, but you only get, a low rate of return as well, 2% if you're lucky. Right? So if we move up the spectrum a little bit, maybe we have bonds, for example. Right? So bonds, you're taking more risk. There's more risks involved with those bonds. But the idea is because you're taking more risk, hopefully you'll get more return, right? So more potential return. Maybe up here we have, different funds, ETFs, mutual funds, et cetera, like that. Again, more risk, more potential returns. Maybe we have individual stocks, for example, up here. Way on here, we'd have crypto, right? Very, very risky, but potentially high rewards, right? So the idea is the more risk that you take over time, the more potential return that you would. So there's also a trade-off between the potential return and risk volatility, right? So for example, some years things go up in value or they increase, they perform well, and other times they don't perform well, right? And the difference between those 2 points is volatility or how much it can change. So let's jump back to the iPad again here, and I'll show you what I mean by that. So let's go back to the savings. Let's say, for example, this is savings in a money market account, right? So today, a high yield savings account or money market account maybe is getting you 3%. Well, the last couple of years, potentially it could have gone up, and maybe you're getting 5%, right? So you're getting more money of that. Or it could go down, right? And you could potentially get 0, right? So 1%. The same thing with maybe a stock mutual fund, right? So a mutual fund, let's say on average, it gets maybe 10%, right? On average. Well, there's some years, for example, like 2023, where S&P 500 got 23%, right? Did very, very, very well. There's other times like 2022 where it does really bad and got negative 18%, for example. So this here essentially is the volatility, what it could do in any given year. So when it comes to market risk, one of the ways that it is measured is at what's called standard deviation. So standard deviation is a statistical term essentially that talks about the moving around the average, right? So an investment has an average. Generally, we look in the rearview mirror, giving an average of what it was. And in some years, it's higher than that. Some years, it's lower than that. Some years, it's a lot lower than that. Some years, it's higher than that. And we call that standard deviation, right? So standard deviation is what's the percent of times it's within this range, or what's the percentage within this range, or what's the percentage in this range. So the way standard deviation works essentially is if we have a bell curve, right? And in the middle of the bell curve, we have the average. So for example, the US market has an average of 11%. And if our standard deviation is 15%, that means 60% of the time, our returns will fall between negative 4%, 15% off the average, or 26%, right? So 68% of the time, it'll fall in between those two, right? So it could be, so not so good to pretty good. That'll be one standard deviation. Two standard deviations, which will be about 95% of the time, it would fall within two standard deviations, right? So two standard deviations, 15 and 15, that would be a negative 19%. That would be bad. Or it could be a 15 and 15 positive 41%. That would be spectacular, right? So for example, in 2008, we were even below this. We had a negative 37, almost 3 standard deviations off. That only happens once a century, right? Very, very bad. Conversely, in 2095, we had, 37%. So we had almost 2 standard deviations of that, right? So the standard deviation is how we measure risk for investments, and it's based upon the idea of what's the probability of success, probability of 68% of the time that we would fall within one standard deviation of the average, plus or negative. So next what I want to do is give you some clarifications on how this really kind of plays out in retirement. But first, if you're finding this information valuable, helpful, do me a favor, please hit that like button down there. It'll help spread the show to other people who might need it. Plus, it's a great way to say thank you and to show your appreciation. So how does this impact your retirement planning, right? So we unpacked last week about how we invest for retirement and how there's kind of two phases of that. And we talked about how on the distribution side, risks are increased, they're enhanced, they're more at play, right? So when you're coming down the mountain, the proverbial mountain, I think they're more increased or enhanced because when you're working again, right, you have a paycheck to minimize those risks. So inflation doesn't really matter as much because you're getting cost of living allowance, right? You can always work more, for example, if you want to, but not so much in retirement. When you're taking money out, right, those risks become even more in play. And consequently, right, there's new ones that take place, right? So for example, sequence of return risks, you didn't have it at all when you're accumulating. The market went down, that was to your benefit because you were buying it at a discount and you're lowering your dollar cost averaging, putting it in. But on the distribution side, so sequence of risk is the idea that if you have a bad market, especially early in your retirement, right? If you have, $500,000 and you take out $50,000, for example, you're taking out 10% of your portfolio. Right. And you can make the argument that's too much, that's too little, et cetera, et cetera. But just for example, right, we take that out, that's 10%. But if the market goes down and your investment goes from 500,000 to 400,000, an example, and now you take out $50,000, you're taking out like 12, 13, 14%. You're taking out a larger chunk of your nest egg, right? So, but consequently, if you have a good year in those first years and your investment goes from 500,000 to 600,000 as an example, and now you take out 50%, you're taking out even less than you were originally because now you're only taking like 7 or 8% of it, right? So the thing is, but you have no control, you have no insight as to what kind of market you're going to retire into, right? So those are our risks. So conversely, what would generally happen then is to avoid that, you would want to get more conservative. You would lower your risk, kind of come down more in the spectrum to the more conservative investments on that spectrum. But you have other risks at play. You have longevity, for example, right? So longevity is the idea that your income needs to last longer than initial plan. You live longer than you might have thought of due to good health, due to medicines, due to technological advances, health, medical science, et cetera. Right? So now you need money for longer, which means you need more income, which means you need to have more growth potentially to last that income over time, right? So that would make you want to maybe move back up the spectrum of risk. Inflation also costs you, right? So again, inflation is the idea that your value of your dollars become less and less every year. The longer you live, the more inflation catches you up from behind. So if you're very on the conservative side of the risk investments, inflation can kind of catch you from behind and you're not growing enough. Right? You don't have enough growth, right? So your income becomes flat and your expenses become higher and you kind of cross the line and you get into trouble. So both those risks would want to make you move more aggressive, right? So how do you balance the idea between sequence of return risk, which would make you be conservative, and longevity and inflation, which would make you be more aggressive? My solution to that, I believe, is the bucket strategy. And it's not my solution. It's a investment strategy, retirement strategy that I believe gives you the sweet spot of both of those. So ideally, you're trying to get some savings, you want some bonds, and you want some funds, right? You want a little bit of each. And that's why when we use the True Wealth Total Retirement System, we have a plan. That plan outlines your needs, wants, wishes, and wounds, what you're trying to achieve. That then drives your income needs, which drives your net cash flows. Essentially, then we base upon your investments upon those. So the money that you need in your first year, the first bucket, we call that the protection bucket, that would be invested in the savings equivalents, cash and cash equivalents. It's very conservative because your sequence of returns risk will be the most predominant in years 1, 2, and 3. We want to keep that money very conservative, right? Years 2 and 3, we need income in future years. So we have a second bucket that is income-based. Here we traditionally would invest in short-term and intermediate bonds because we need to pay income in a couple years. We'd have years 2 and 3 money in there. Historically, who knows what will happen in the future. Historically, a market turn down generally lasts less than 3 years. So if we have 3 years of money out of the market that's not at market risk, we have potential to weather those storms, right? Now, we also have, again, we have inflation and longevity risk that we also have to manage. So we still need growth. And so years 4 and beyond go into a growth bucket. And this is where we generally would have equities or mutual funds or ETFs where we're trying to get growth, right? So we have 3 different objectives, 3 different time horizons. So we have 3 different purposes. Therefore, we have 3 different allocations based upon those years. And from my perspective, it seems to solve the puzzle of complexity, giving you the greatest gains and optionality and flexibility. By far, the biggest risk to all of this is the emotional human risk, right? The man or woman in the mirror, making the wrong decisions at the wrong time, which is why it's so important to let your plan drive your investment decisions and not your emotions, which is how this all works together, right? So we have a plan, drives our income needs, it drives our investments. And then when the market goes down like it did in April, thankfully, none of my clients let emotional risks drive them because we had a plan and we were able to communicate that plan. We know what we're doing. And thankfully, it didn't get that bad and it turned around and we were able to kind of ride through it. Little twist, little turn, little nauseating, a little sickening, but you just kind of ride on through. So now let's circle back to my original question. If I offered you investment A that got a rate of return of 11%, and I offered you investment B that got a rate of 5%, which would you choose? Hopefully, you'll now respond of, it depends how much risk is involved, and more importantly, what are my objectives or purpose of the investment? As we conclude, if you're still with me, please consider subscribing. Help spread this information to others who might need it, and more importantly, you'll be notified of future episodes. Today, we talked about investing risks. We talked about the different risks involved, the ones you can control and the ones you can't. We did a little bit of a deep dive into market risk, and we explored how this plays out in retirement. Now, ideally, all your investing and everything else you do should be done in consideration of an overall comprehensive plan, one that considers your investment and objectives, goals, income needs, timing, aspirations, and a whole lot more. I understand how confusing and complexing and overwhelming this can be. So if you have any questions, please feel free to put them in the comments below or send an email to mike@truewealth.show. But for today, a good micro action for you might be to use the link in down below and go to Portfolio Visualizer, add in your investments, and see what your standard deviation is. Because that'll give you a good idea of the risk that you have for your investments. Remember, when it comes to investing, risks and return go hand in hand. Hopefully this helps you on your path to a prosperous, enjoyable, and purposeful retirement. Till next time, hope you have a great day. God bless you. And for taking the time to watch this week's episode of the True Wealth Retirement Show. But just a couple more things before you leave. Number one, if you're looking for any help with your retirement planning, or you know anyone who might be looking for some help, I offer a 30-minute, no-cost, no-obligation conversation to anyone, and I'll try to point you in the right direction. Number two, if you're looking for some resources to help plan your retirement, check out planyourchristianretirement.com. And one final note before we wrap up. While I hope this information is helpful and valuable and insightful to you, it's really meant for informational and educational purposes only. Prior to making any decisions or taking any actions, I strongly encourage you to talk to your legal, tax, estate, or financial advisor who's familiar with the unique circumstances of your particular personal situation. Thanks again for watching. Until next time, hope you have a great day. God bless you.